So it's perfect. And there you go. Perfect. 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 All right, good. So we're opening up everything and getting people loaded in. We see people coming into the room. That's perfect. You grab a pad of paper and pen here. That's crazy, Elaine. So you've been at it. You've been at it a while. So that means, what were you doing before that? Were you processing before that?
I was at the bank as a bank teller, new accounts, installment loans, and commercial loans.
Ah, that's funny. So
Yeah.
we have, oh, I have to show you. So we have these mugs around here. So you know how people are with the Zoom and they're all
Yes.
muted. So we just got these Team Kimball mugs. So if anybody likes these in the chat, we're actually going to order some of these. So
Oh, that's
if you're on a
great.
Zoom call and you can't hear anybody, then we're going to show that up. So it's
That's
pretty
great.
funny. Yeah. Well, good. We got the room loaded and we are getting ready to roll. So we're going to do a couple quick little housekeeping and introduction things. You guys will be able to communicate with us in the chat. We don't have a PowerPoint today. What we have is a lot of questions that were already given to me by agents that we polled over the last couple of weeks. And Elaine knows some of these, but you guys are certainly welcome to ask your own questions. We are very, very honored to have Elaine here. Elaine is one of our senior manager underwriters and just a wealth of information. And as she said, I was kidding about looking up her bio, but she said she's older than dirt and she got her DE in 1986. So DE means direct endorsement, which means that she could underwrite FHA loans. So that's how long she's been doing it. So we've got we got a little history there. One other quick thing about Elaine, because she's out in California, she is not a gamer, but since she has to sit in a
Yes.
chair all day, she has an awesome gaming chair. So you guys, that's what that is. So anyhow, and I'm Rich Kimball with CrossCountry. We're going to jump right into some of these questions. You guys had some really, really good questions. Oh, one more housekeeping point. There is a chat box in here. So any questions that you guys have, put them in the chat. We'll read them and review them and get through. But in the meantime, I literally have a list of questions for you guys or for Elaine. Fortunately, we gave them to her ahead of time so she doesn't feel like she's being interrogated. So with that, this is just such a great start, this question. So Elaine, what exactly does an underwriter do? And can you kind of explain that process for when you get a file as an underwriter?
Well, good morning, everybody, or afternoon, depending on where you're located. I think for most of you, it's afternoon.
It is.
For me, it is still morning. Uh, we get the loan in underwriting after your loan officers and processors have done all the hard work of getting the seller and the buyers to cooperate and give all the documentation. So we get this wonderfully packaged file from the processing department to review and make sure that it meets the guidelines. So we have it just 2 touches. That's our goal. It comes into us, we analyze the entire package, make sure it meets the investor guidelines that it's slotted for. If it isn't, we try to help the branch restructure it, condition it out for anything that may be still missing. Then it goes back to processing. And then it's
Perfect.
back in the processor's hands to get it finalized and sent back to us for that final clear to close.
Yeah, and the processing, so that you guys know, there's a lot of hands in there. We always like to use the comparison or the analogy of a pilot in an airplane. Like you guys will get on a plane and you'll see the flight attendants and you'll see the pilot, maybe you'll see the gate agent, but there are so many more people that are involved in getting that plane from Chicago to Hawaii or Chicago to Vegas or Florida, wherever you're going. A mortgage is very, very similar to that. You guys are going to see the loan officer. Which you don't see is if the loan officer has assistants. You may not ever meet those folks. You don't see a loan opener who, when they receive the file, they open and start all the ordering. They then give that to a processor who reviews all that data, asks the client for any data they feel the underwriter is going to need, then collects all the information that was originally ordered, and then at that point then sends that off to underwriting. So there's a lot of parts there and everybody has to be really good at their job. Here at CrossCountry, really the goal is we only see underwriting twice. And if our processors are sending the loans up to underwriting more than twice, then we're not really doing a good job. We're not helping our underwriters get through the file process, and we're probably not doing a good job on the front end. The good news is, as a company, we track that stuff really well, and we know where our weak points are so we can jump in and train. So I did get a question right off the bat that I'm going to read. This is good. It kind of goes back to something what we're talking about. So Kathy asked, why does it always seem that when I write a 45-day contract, it well, I guess I should read this the way she wrote it. Why does it always seem to be I write a contract with 45 days only for it to be extended time and time again? Isn't 45 days enough? I'm confused. It kind of goes into what we're talking about, the process flow. You really need to have an excellent loan officer, a great processor, and an outstanding underwriter. If you have all of those things, you shouldn't be running into extensions. I don't like them personally, so I know I make sure that the file flow, and I know Elaine does a great job managing the underwriters to make sure you will get that kind of delay, Kathy, when we as a processing or a branch are keep submitting loans to underwriting. Here, try this, see if this will work. It's just not the right way to do business. So all starts with the great loan officer. It really does. And Elaine, I'll let you add to that if you have anything.
Yeah, some the it kind of goes to some of the other questions that we're talking about today, that it depends on the borrower, their qualifications. If everything has been disclosed up front by the borrower and hasn't, surprised us with a gotcha, they haven't been out shopping for new cars and new credit cards while they were in the process. There's all these things that delay. And there's definitely some loans that are more complicated. If you're dealing with bond loans, those are going to take longer because it has to go through another department. And then in some markets, we're having difficulty getting appraisals in a timely manner. So we've got extended time delays just because we can't get an appraisal. And I've even got a couple markets that title companies are taking 2 and 3 weeks to get us the title work. So
Yeah,
it's
we're
all these people involved.
Yeah, and we're very fortunate here in the Chicagoland area. Our appraisers are actually still turning things around in a reasonable time, at least the ones that we deal with here. And when I say reasonable time, guys, in California, it's not uncommon for a lender to tell a buyer they need to pay $1,100 for an appraisal that is a rush appraisal, only so that the lender can get it back in a matter of 21 days. So they're literally, I mean, we're getting appraisals back here in about 10 days. They're paying 2.5 times what we pay here in Chicago just to get an appraisal back. So we're very lucky. Some of those things are not happening here. One thing I will say to Kathy's comment too, that 45-day contract, we typically are not going to order an appraisal unless we know the home inspection has been clean, because we don't want to waste the buyer's money. So we're really kind of on hold till you guys get through the inspection to the point where we know the buyer's going to move forward. So if there's a couple week delay because the seller doesn't want to know and the buyer's not sure if they're going to do it and blah, 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 that is 2 weeks that we would potentially lose unless instructed by the agent or the buyer. Go ahead and order the appraisal. We'll risk losing our appraisal fee if we can't get the seller to agree to whatever repairs that we need to get done. But yeah, that 45 days for us sometimes isn't 45 because we're waiting to get the home inspection. Because regrettably, in Chicago here, we have a lot of older inventory, and sometimes, as you know, houses don't pass the inspection, assuming you have an inspection clause in this crazy market. But
Yes.
um, so the next question, hopefully we covered that for Kathy. The next question is, when does a loan go to underwriting? Here at CrossCountry, we really have the requisite that we either have to have title or appraisal in on a purchase. If we have one or the other, and the processor feels that they have enough information to give the underwriter a really good look, they have the income documents they need, they have the asset statements they need. If they feel that they can give a good, clean picture to the underwriter without the underwriter feeling like they're Sherlock Holmes and having to just go through everything and they don't understand because they have pieces of this, pieces of that. Again, for us, title or appraisal's in, and we have the majority of our docs, we're going into underwriting at that point. So anything you wanted to comment on that piece, Elaine?
No, you got it right on.
Okay,
That
perfect.
the more complete that package is when it comes in, the faster we look at it. It takes, we're at 48 hours turn time here right now, which is phenomenal.
Mhm.
And it takes an underwriter about an hour to 2 hours to review that initial package.
Perfect.
So that's
And and
give you a
we
time
talked
frame.
and we talked about that too, is it's the one thing that when we get a document and we're able to get that off to an underwriter, they're not just waiting for that one loan. They need 48 hours because there's probably 12 loans ahead of when we submit our document. Let's say we're submitting our loan for clear to close. Well, our loan just got in line, maybe behind 8 other loans. So it's going to get looked at in 48 hours, but it's not going to get looked at in 48 minutes. So that's one thing that we just want to make sure everybody has an understanding of. The next question, which is really good, it kind of says, well, why, Elaine, do we need so much paperwork? I'll let you handle that one.
Well, we are show me people. Underwriters need to see what what's going on, and it's still in our mortgage industry, as you all know, just by your purchase contracts and all the disclosures you have. We're managed by the regulators. So there's all these requirements we have to meet, all the paper we have to have in the file to support the income, assets, credit, meet all the investor requirements. And a complete file means that we are actually analyzing those old 4Cs. So anybody who's been around as long as I have, and Rich, you know the 4Cs from back in the day. We don't talk about them so much anymore, but
No.
it's character, capacity, collateral, and capital, which in our English today is credit, income, assets, and property. So all it has to be documented. It takes a lot of paper.
Yeah. Well, and there's a great follow-up question to that, which is why, Elaine, does the blank page in a bank statement have to be submitted? We get this question all the time. If you guys, a lot of people don't get statements anymore, but if you're getting your statements mailed to you, and I know Chase is notorious for this because we bank at Chase, there may be something in their printout where there's nothing on that page, and the homeowner or the buyer decides, hey, I'm not going to send that page because there's really nothing on there. Why, Elaine, do they need that page 4 of 8? Why does that need to be there when it's blank?
Again, that show me and the ugly answer of the agencies require it. It's in their guidelines. You have to have all pages of the bank statement. So if we have just 4 of 5, that loan won't be purchasable. Believe it or not, they'll make us indemnify or repurchase that loan because we don't have page 5, or we're
Yeah.
going back to the borrower after closing and asking for it.
And ultimately, page 5, we know the borrower knows there's nothing on that page, but we don't know that there's nothing on that page. What if there's a loan on that page that they made directly with the bank, and that's the only place that it shows up? So that could have information that would have a bearing on our decision, and more importantly, the saleability of that loan. So this is kind of a fun one. We talked about this a little bit. What does a complete package look like, and what are you looking for, Elaine?
Those 4Cs, we start off looking at the borrower's credit, any explanations, the income, how are we qualifying? Do we have the history? Do we have the stability? Does this borrower can they show us that we have the ability and willingness to repay this mortgage? And then we have to look at the assets to make sure they have for your down payment and your closing costs, and then the collateral. Do we have a sufficient collateral in case that borrower doesn't repay, that we can recoup our losses?
No, that's perfect. So I'm going to jump into some more specific underwriting questions. I think we talked a little bit about the process. We may circle back with that, but what concerns would an underwriter, or I'm sorry, what concerns would an underwriter have about a client who gets a short sale?
What is not really known across, if you're not an underwriter or even in sales, is that any foreclosure, short sale, pre-foreclosure, deed in lieu of foreclosure. Those are all foreclosure activities. And so even a short sale or a deed in lieu is going to be counted against the borrower as a foreclosure. So we have those seasoning requirements that have to be met.
Correct. And the seasoning requirements will vary depending on whether it's conventional or FHA, if they have extenuating circumstances, and even what the extenuating circumstances might be. So most of your good loan officers will know all those dates and everything. So, all right. So this one came up quite a bit when we were polling. What can a realtor do? The people that are listening today, what can a realtor do to make sure that the paperwork and the conditions are being collected in a timely manner? So go ahead.
Oh, no, I think we both have this pretty much the same answer, but what I see is the borrowers being engaged. So if you help us with that process right up front to make sure that borrower is engaged, if we ask for something, get it to us immediately. If they wait 48 hours, that's 2 days in the process that have added to that previous question of why does it take 45 days? The borrower isn't engaged and giving us what we need, then it's going to slow it down.
Yeah, and I think to follow up, I didn't mean to take a point away from you on
No, go.
but I think to follow up on that, there's two things there. Number one, the processors, when they send something out, if they get something back immediately, they realize this is going to be an easier file for them. And they are going to, that file, honestly, it just stays at top of consciousness. Oh, hey, I'm working with the Smiths. They're amazing. When I ask them something, I get it within a couple hours and I can keep doing my job and moving this file forward. So the responsiveness of the borrowers is really important. Now, what can the agents do? Well, guys, you've been working with these buyers, showing them houses, making offers, regrettably, maybe even making multiple offers, and been spending a lot of time. If you know these buyers are not particularly organized, maybe always late for their appointment, that's probably some signs that they're going to drag a little bit when it comes to providing paperwork to us. So just encourage them that, it's really important, especially in today's market where a seller could have 3 backup offers and just be waiting for the buyer to make that one mistake, like missing a commitment date or missing a closing, to let our contract go and go find somebody else. Honestly, in my process, the way we work things here across country, the biggest delay that I see is borrowers dragging their feet. We're blessed that we have a decent appraisal turn times. The title companies are fairly reasonable with everything as long as the seller's attorney is proactive. The biggest delay is getting that documentation from the homeowner or the potential homeowner. Elaine, anything to add to that?
Just stay in contact with your loan officer. They're
Yeah.
the most valuable piece of the process for us in underwriting. And they're going to be able to keep you up to date with what the borrowers are doing or need to be providing. And you can be our sidekick and get that information in.
Yeah, most of the people on our team, we're doing Tuesday status calls, and most of the guys in our office are trained to call the borrowers every Tuesday and just give them kind of an update. Our processors do an amazing job. We have some of the best processors in the company, I think, out of our group here. But
Agree.
our loan officers follow up again as well, so we know exactly what's going on. All right. Elaine, why would an underwriter disagree with an appraisal?
Oh, well, that pesky investor that we have to sell the loan to. We have to meet all of their requirements for that appraisal. And even though the appraisers know what the agency requirements are, especially on FHA, they don't always comply or can't find the information or don't convey that information that they know to us properly on the report. So we've gone through extensive training. We've taken courses. Here at CrossCountry, we also have an internal appraisal department that we can lean on so that we don't have to ask and pay for additional AVMs and field reviews or second appraisals. We have them to bounce things off of if we're not sure, and it also helps us from over conditioning on appraisal items.
Yeah, and our appraisers here are pretty phenomenal on my market, and our appraisal review department, I can only think of 2 appraisals in the last 3 years where they've had any other questions about the valuation.
Right.
Um, at least with CrossCountry, our appraisers are all people that we put on a panel. We're still required to use these large panels of random appraisers, but we're the ones that build those panels. So we have people in there that we know they do a good job. I can't say that for every appraiser. I know my friend Joni, an agent, sent me an appraisal, and we were looking through the appraisal, and she went through it and found that the appraiser was using data that was almost a year old in the appraisal. So there's definitely things that are wrong in some appraisals. And to the point, there was kind of a follow-up question here, Elaine, like how could you question the value of the property when you actually haven't been to the property, but really you're not questioning the site, you're questioning the report that was generated on that. Did it make any
Correct.
sense based on the
Right.
rules and guidelines we're given?
Right. That appraisal needs to be self-contained. And if we can't determine that what the information is accurate through the internet and through our knowledge of the area, since our underwriters are familiar with the markets that they underwrite in. Our underwriters are underwrite for specific markets, or myself. So we, if we can't determine that, then we're going to, we're going to go back to that appraiser and ask him for additional information.
Right. And it's just information that doesn't make sense. There's when they're pulling in comparables, and I think there's a tolerance of about 20% for adjustments. And once you go over 20%, that tends to raise an eyebrow from an underwriter. So that means you're pulling a house that does not really compare to the house that we're trying to appraise once you go over those 20% tolerance. And maybe there's some reasons for it in rural markets and things, but they are trying to take a look and make sure the comparables are close to what we're dealing with in the house that they're looking at. I actually like this question that we've got. So the next question we have, Elaine, is what are the less obvious issues that kill a deal?
Oh, let's see. I wrote down some so I would remember them all. Disputed credit is
Right.
a big one. So borrowers think they're doing themselves a favor by disputing derogatory credit or other collections on their credit report. It just makes it more difficult for us in underwriting. And sometimes we actually have to have them remove those in order to get an accurate credit score.
Right. And disputed, I want to follow up on that a
Oh,
little bit.
sure.
So federal law allows a consumer to dispute anything that's on their credit. But when they do that, what happens is that if they dispute one particular credit item, that item is actually not accounted for when the score is generated. And even Fannie Mae will come back and tell us when we underwrite, hey, these accounts are disputed, and we would like you to remove those disputes and reorder the credit report and re-underwrite this loan. So it boils down to we couldn't even sell that loan if we wanted to. So that's a
Right,
good point.
right. Our pesky COVID overlays, hopefully those will be over with soon. We have some deadlines and we're praying that those stick this time, but they have caused us a lot of, well, I won't, they're speed bumps. The COVID overlays
Yep.
are speed bumps, but they can sometimes kill a deal, especially on the self-employed borrowers, when we have to get current P&Ls, current bank statements to support that income. And if they had a tough 2020 because of COVID, and they were closed shop, a restaurant was closed for 6 months, we don't get to eliminate that time period they were closed. We still have to look at the full 12 months.
Yeah, that's been kind of I mean, I remember when Jennifer, who is our senior appraiser, I don't know, I forget what's her title. I should know this, but she basically oversees everything with regards to the company and
Mhm.
underwriting, of course. But when she saw the COVID guidelines come in, that she was a little bit upset because she thought it was going to be a little bit rough, especially on a lot of our self-employed. In the COVID guidelines, the biggest differences really are, now we're asking for 3 months most recent business bank statements on a self-employed borrower to establish that the deposits coming into those bank statements are kind of coincide with the profit and loss statement that they've generated. So that's definitely new. We were not doing that prior to the pandemic. And then the other, having a most recent profit loss statement almost up to the last most recent closed month is definitely new. We would only usually go back to the previous closed quarter. So, and then the last part about that, what Elaine talked about is if they only worked 6 months out of a 12-month year, we're dividing 6 months worth of income by 12 months to determine income. So that was definitely not doing anybody any favors. And lastly, those PPP loans that these businesses were getting to survive, Fannie Mae, Freddie Mac, FHA, they've all come out and said you need to exclude those funds from revenue and income because technically it's a loan. So
Right.
it's been really rough on the self-employed borrowers. Elaine, we have a follow-up question on the disputes. Ray was asking, is there a timeline on the disputes? And I think what he's referring to, I could be wrong about this, but is there, if there's an old paid collection from 5-6 years ago and it's disputed, what are you going to ask the borrower to do?
We're going to look at it. It's a subject to answer. When we pull the AUS, so the automated underwriting system, whether it's desktop underwriter from Fannie Mae or loan prospector from Freddie Mac, it's going to condition us because it's going to read that dispute. And depending on the borrower, rest of the borrower's credit performance and credit history, it'll ask us to remove that dispute, no matter how old it is, or it could just leave it alone and ignore it and say, we don't care.
Right.
So it really depends on your borrower.
Yeah. Yeah. And I hope I answered Ray's question. If not, Ray, give me an update on that. Let's see, we talked about that. Also, well, this kind of segues into this. So this is kind of a bold question and we're going to cover it, but probably not in the most minute detail. Elaine, what are the requirements for an FHA spot condo approval?
I was prepared for you. I pulled up my list. And I will say that not every lender will do these spot approvals because that's a manual process and the lender has to take full responsibility for that project meeting the requirements. It doesn't go to HUD. So, but the good news is CrossCountry does them. And another good news for you is that because I'm out here in California, I live just outside of San Francisco, we do a lot of these condos out here. So I'm really proficient in them. So you have that on your side when you're doing business with Rich. There's not as many, but Chicago is getting more and more and more condos, and it's such a great product. But what you're going to need, there's 8 basic things that you need. And I can send this to Rich and he can send it out to anybody who wants it. Let him know. But first off, you have to verify that the project is not on the HUD approved list, or that hasn't been rejected in the past, or has been removed and is now considered an unapproved or expired. The borrowers must have an approved eligible scorecard decision. So total scorecard is FHA's DU, desktop underwriter, and that has to be approved. If it's a manual underwrite, you're reduced to a 90% LTV. So that's really critical and a big mistake people make on these.
Yep.
The third option, or the third item, is the HOA questionnaire. It has to be that full-blown big one with all the questions. We need the master insurance policy, fidelity insurance, flood insurance, and HOA, the HO6 policy. Recorded documents, all of them. So you get with your title company, you need CC&Rs, bylaws, articles of incorporations. You need the budgets, reserve assessment, and any financial special assessment litigation, anything like that. So if the condo association had extensive repairs and they had to charge each of the homeowners with a special assessment, we need all that documentation and why. Then we get into the project eligibility. These are more generous than Fannie Mae. So in that respect, it's you only have to have the certificate of occupancy has to be issued at least 1 year prior to the certificate of eligibility, no, the case number assignment. Sorry, I got VA thrown in there. So your case number assignment, you have to have, the project has to have a minimum of 5 units to do this, these spot single unit approvals. No manufactured homes, no co-ops, no condo hotels, no mandatory rental pools, timeshares, or multi-dwellings or houseboats. That's pretty standard. I'm saying a lot, sorry. 10% of the units cannot, or FHA limits their exposure in a condo project that's not approved to 10%. So if it's a 10-unit project, that's 1 unit can be. So that's the biggest deal killer on these, is that FHA already has too many loans in that project. So that would be the first thing that I'd have you go check, along with, is it a HUD approved project? And then you have to have 50% owner occupancy. Only 10% can be related parties. And so this is one thing that's different about FHA than conventional, is that they consider a single entity also related parties. So if you have parents and kids owning units in the same project, then it's counted as a single entity because it's a family unit.
Even I didn't know that.
And yeah, and we've got some that are, businesses. Somebody, gets an LLC, will buy a couple units for rental. And then the owner of the LLC also has one for their own owner occupancy. So now that person maybe owns 2 or 3 units. Yeah. So it's related parties.
And I would tell you too, as we're going, I'm sorry, Elaine, you got, if you have more on the list, I would tell you the one thing for us, it's, we warn everybody as we go into these transactions. Number one, you'll probably want to give us at least 45 days on the contract minimum. Number two, the first thing we'll do is go to HUD and find out if it is a project that they had approved, declined, and what their percentage of lending is in that project. And the misconception is, once they tell us, hey, no, you guys are good to proceed, doesn't mean we're approved. It just means we've checked a couple of the boxes on our long list that we have to check. So that's the first thing. The second thing that you need to make these work is an association or management company that's willing to work with you. If you don't have that, then everybody's wasting their time, because we do ask for an extraordinary large amount of paperwork. And lastly, I will say that on these, since we've been doing them, our success rate is roughly 1 in 5. So we are getting them done, but usually there's a hiccup somewhere along the way that they don't check the boxes. And we've even had one just where they just didn't have enough insurance, and HUD was like, no, we're not going to lend here because we don't feel the complex is properly insured. So with that, Elaine, if you've got more on your list.
Oh, just some simple finals. The reserve requirement is also, in addition to the issue with the all the documentation, is that reserves in that P&L, that financial stability of that HOA, they have to have 10% reserve set aside. So in addition to that insurance being a problem, that we lose the loans because of that, we'll lose it because the HOA does not have enough reserves.
Yeah, and it's 10, and when they talk about 10%, it's like 10% of annual revenue. So right. That's what they're looking at. So 10% right. Annual revenue, they should be keeping in a bank account somewhere. So right. So we had a couple questions come in on the spot condo stuff. So we'll spend a little bit of time on there. Right. First of all, Ray asked if we can get a copy of the list. Elaine's going to send the list to Tony, and Tony will get you guys a copy of the list. So that's good. And we had Greg ask for a copy of the list. That's perfect. And let's see here. Joni's question is regarding spot approvals, any financial standing preferred or not likely to get approved? Any data points we need to be aware of before making the appointment? I think she was talking, well, from a financial standing, I think the biggest thing Elaine just covered is that 10% reserves. And I guess, do you want to talk, Elaine, too, about the delinquency? Because that tends to be a hard stop as well.
FHA allows for only a 15% delinquency period. That's a 30-day, where Fannie Mae is at 60 days is what they consider delinquent. FHA is 15% of 30 days in arrearages.
So on homeowners, so if you've got a 10-unit complex and you have 2 homeowners that are over 30 days past due, that's going to be a hard stop for getting that complex approved. So
Correct.
that's what we're talking about when we talk about delinquency. I would like list of spot approval we could have. Okay, good. So Kathy's asked for the list too. We'll have Tony send the list out to everybody that's on here. So we'll get you guys the list. So there was one other, oh, here we go. Going back, John had asked, and I didn't forget you, John, but we get a lot of questions coming after that on condos. John had asked on the, Elaine, could you use the PPP as income if they had documentation from the government that the repayment of that specific loan was not necessary?
Unfortunately, the answer is no.
Okay. And that's coming right from Fannie Freddie. That's not, trust
Right.
me, we want to help these borrowers just as much as we can, but we also, that's not really healthy for us to make loans we can't sell. So,
Right.
but that was a great question, John. It really was. All right, back to our list. So Elaine, what do you use for payments on student loans?
That's I hate this when I'm listening to people and go, oh, that's a great question, but it really is a great question. So I'm going to use that term. There's an advertisement on TV that this woman, every question is a great question.
There you go.
It drives me nuts. So again, it's different for Fannie, Freddie, and FHA. And this is where the loan officer can really help you structure the loan with the borrowers, because the options are so different. And they're so different that I actually said, I've been doing this for a long time, but I keep this little cheat sheet because I just want to remember when I get to these. So FHA, you cannot ever use a zero payment. So if the borrower is in deferment or they're on an income plan and it's a zero payment, you can't use it. You have to use the greater of the 1% of the outstanding balance, or the payment on the credit report, or the actual payment fully amortized on the statement.
Correct.
So most of the time what we have to do is get that statement from the borrower, and there's usually 3 or 4 different options, and we have to look at what the one that is fully amortized for FHA. For Fannie Mae, we can use the payment on the credit report, or we can use the payment on the current statement, or if there's neither one of those, we can use 1% of the outstanding balance to qualify. Now, where Freddie Mac comes in and gives us even a bigger lift is theirs is 0.5% on the outstanding balance. So when that borrower's ratios are really tight, we just flip it to Freddie and go with the 0.5%. And Freddie will also accept the zero payment on the credit report. So it's the easiest slip through, but it's not always the best priced.
Got it. So Juliet was asking if anybody else's is freezing up. I haven't heard anything yet, Juliet. I know we had one little glitch there with Elaine for about a half a second, but other than that, I think we're good. So, but student loans is a big deal, guys. Obviously, we have the Smart Buy program. We did get notification recently from IDA that we probably need to get those registered sooner than later, which is, I think, our first warning that they may eventually be running out of this money. I had thought maybe by midsummer the money would be there. The IDA Smart Buy, or the down payment, that's the down payment assistance program from the Illinois Housing Development Authority, provides the buyer with $5,000 of down payment and up to $40,000 worth of student loan forgiveness. So great product, but keep in mind it may not be there late summer. So at least this first run before they get more funding. All right, so we've got this is it's an interesting question, Elaine. So is there anything that we need to ask or be aware of when we are working with other lenders that may not be as well known? So they're getting a pre-approval letter from Acme Mortgage, we'll say. And I hope there isn't an Acme out there, but I was thinking of the cartoon, so the Roadrunner.
Overlays, the dreaded word overlays. So CrossCountry is a direct lender, and our appetite for risk, which is another catchy word, is great. We are aggressive. So we are going to follow the guidelines. We're not going to add any of our feelings about the loan. We're going to check off the boxes, make sure that the loan meets those requirements and not add anything else to it. Other investors who deliver to other lenders who deliver to investors or deliver maybe a wholesale broker who doesn't have authority to approve the loans, they have to deal also with those lenders' overlays. And some lenders are risk adverse. They do not want risky loans. They are going to overlay with minimum credit scores, with minimum reserves, with employment history, those types of things. So
Yeah, that's a great point. I can't tell you how many times people have come to me and said, "Well, I heard you can't do FHA under 620." It's like, excuse me?
we do them with no scores.
Yeah, we do. So the point of the matter is you can go below 620, but they probably heard it from a lender. Like I think Chase's current limit for FHA is 640. So I don't think they go, and on the retail side, they're not going below 640. Well, FHA will go down to 500 with the right down payment and an automated approval. So,
Right.
and we've closed those loans here. So when you are dealing with the kind of that no-name lender, that would be, that would be my concern. What additional rules and or guidelines do they have? Let me just check the chat. So what's the criteria for the student loan forgiveness on the IDA program? So I'll cover a couple things here. So probably 9 out of 10 IDA loans that we do here, the Illinois bond loans, are government. This particular program is only conventional. So assume a little, even though IDA's minimum credit score is 640, assume that you're probably going to have to see a little bit higher credit score to get that approval. That's number one. Number two, these student loans have to be completely wiped out at the closing for the borrower. So if the borrower is coming to us with $120,000 worth of student loans, they will not give them 40 and leave them with 80. The way the program is set up, all of the student loans need to be paid at closing. Now, one thing people forget about though is that if one borrower has 20,000 and the other borrower has 120, we can eliminate the 20 and not worry about the other borrower. So we won't be able to use that extra money that we get, but we can at least clear all the student loan debts from that borrower. So I hope that those are kind of the big sticking points that I see on the IDA side. What is the rate for a 620 credit score? Is 620 only FHA? So rates really for 620, I think I priced something the other day at 580 that we had, and I think our 580, if I remember right, had, if a going rate on an FHA today was 2.75 and no points, it would have been 2.75 and 1.25 points. So that was the extra they were charging for a little bit lower credit score. So there's a little bit of a premium that's charged by the lenders for that. And is 620 only FHA? Fannie and Freddie go down to 620. FHA goes down to 500. However, once you break 580, minimum down payment increases on an FHA loan to 10%. So all right. So I think we covered that. And what do we want to do? Let's go to, here we go. So Elaine, when should one get concerned about a file in underwriting?
When you haven't heard back from your loan officer in 48 hours.
That's it right there. Yeah, that's it right there. If that file's lost in underwriting, yeah, that's a problem. Yeah, that's definitely a problem. This is a good one. I'm going to make sure we get some of the better ones on here so that are more detailed relative to that. What are some of the red flags on bank statements that could affect an approval and why? I can think of a few, but I'm sure you've got a good answer for this.
Oh, let's see. When we look at bank statements, it's a requirement. It used to be we just looked at the bank statement and looked at how much money the borrower had in the account. We were good. over the last couple of years, it's gotten to where large deposits, especially Fannie and Freddie, anything over 50% of the borrower's income has to be documented as to the source and seasoning of that money. And some of the borrowers get real resistant to that.
Hey, can I stop there, Elaine, for 1
Yes.
second?
Yeah.
So when you said over 50% of their income, so so if they're making, excuse me, if they're making like $4,000 a month, and there's a deposit over 2,000,
Yes.
is that okay? Good.
That's
So,
correct. Very good.
excuse
Yes. So, and it's the total income. So if you had two borrowers and they each made 2,000 or each made 4,000 a month, it was 8,000. That large deposit could be anything over 4,000 in that case, because it's the total income.
Perfect.
FHA, it's what's typical of the borrower. So we look at the bank statements and see their regular normal deposits, and suddenly, everything's normally 1,000, 2,000, 2,500, and suddenly there's a $5,000 deposit. We're going to ask for that on an FHA loan because it's not typical of their normal transaction history. NSFs, biggie. Do not give us bank statements with NSFs on it. That tells us that the borrower has fiscal responsibilities that they're not keeping up with, that they don't know how to manage their money. So it's a red flag for us. Joint accounts. The accounts are for people that aren't on our loan. So if they're joint with kids or parents or girlfriends and boyfriends, that becomes problematic. We look at all the deposits. So if a borrower tells us they work at Walgreens and we're seeing direct deposits from Target, we're going to ask, why do you have direct deposits from Target? We're nosy. We're going to ask. And then debts. The other big one is we're really looking for any debts not disclosed. So we have borrowers who pay their kids' car loans for them. So it's not on their credit, but we see in our 2 months bank statements that each month on the 15th is a payment for $738 going to Chase.
Right.
We're going to ask, and then we're going to document that that is not our borrower's account, it's the son's account.
Yeah,
those are the biggies.
There's also a lot of times you'll see on there, you'll see also for child support, all of a sudden you're seeing a child support deduction that comes out of there, and they never disclosed anywhere, even though we've asked the question, hey, are you paying alimony to child support? We asked that out of the gate because it's such a deal killer. And this is where a great loan officer makes a big difference. We ask the questions ahead of time. Honestly, sometimes we just don't get the answer. I don't know if people forget or they're like, hey, this is my 17th question and I'm used to saying no. I don't know what it is, but the bottom line is we'll get into that bank statement and there it is. There's a child support, deduction coming out, and we got to go circle back to them. And child support's a big portion of income, regrettably, and sometimes that can torpedo a loan. So that'll show up on a bank statement as well.
We also see that on pay stubs.
Oh yeah.
The other one is that they're garnishing their pay stubs for it and it's not disclosed.
Right. Yeah. So it's a good question. Kathy asked this question. So Elaine, are we ever going to get rid of TRID?
No. Not unless we get rid of the federal government the way it exists today.
There you go. Yeah, TRID's not going anywhere. So, all right. So Vanessa asked if there will be a recording. There's definitely going to be a recording. And Joni, I think, was following up on a question. I want to try to tie that back up in there. Any data points need to be made aware of? Oh, here we go. So Joni asks, regarding bank statements, we were just talking about it. What if you are on someone's bank account, but no funds are being transferred? Is that a detriment?
It's not a detriment. We would ask for a letter a letter of explanation from our borrower, who that other party is. And then that party also has to sign that letter saying that our borrower has full access to all monies in that account. And we're going to scrutinize it very closely to make sure that all the transactions are our borrowers and that there isn't deposits, especially deposits, are from that other party. We want to make sure that the money in that account is really our borrower's money.
That makes sense. Here's a fun question we were kind of looking at when we were kind of going through these yesterday. Does it exist that the underwriter would have different criteria than the loan officer?
Daily is the honest answer. So look
True.
at this perspective. Loan officer, and I've been a loan officer and I've been a sales manager. So I get both sides of that hat. They're on the sales side, and our great loan officers are salespeople, and they want to make this loan. They're going to do whatever it takes to make this loan and get it working. Underwriters are a third disinterested party, kind of. We're looking at just the paper. We haven't met the borrowers. We don't know how nice they are. We don't know how many kids they have, or that they're taking care of their elderly grandparents. We don't know the story. We just see the paper. So yes, we're going to have difference of opinions because the loan officer is more emotionally involved with those borrowers, and we're not as emotionally involved. Although we're voyeurs and we see the story and we get curious. But we're all with the same goal. At the end of the day, we're all at the same goal to make those loans, approve the loans, because definitely as underwriters, we don't get paid if we don't fund loans.
Yeah, and that's something important for you guys to know, that underwriters aren't there to make everybody's life miserable. They're there to make sure that these loans are getting closed, and ultimately they sign their name on them. So if they make mistakes, people come back to them. These mistakes are very, very costly mistakes, regrettably. They can be. And so if they get in trouble for them, then, that's that they want to make sure they still have their jobs tomorrow and everything else. But at the same time, they're not getting paid unless those loans are getting closed. So, the other difference, and we kind of laughed about this, is, we have great underwriters here at CrossCountry, but, your loan officer's knowledge is really, really important too. They have to at least be cognizant of guidelines as much. And guidelines change all the time. And sometimes, like through the pandemic, the COVID overlays have been updated, 11 times since last March. I mean, there's an update almost every month from Fannie Mae. Oh, we're going to do it this way. We're going to do it this way. We can accept this. You can do this with the forbearance loan, this type of thing. So, the changes are constantly coming. And there are times with an underwriter may be aware of a change that came where Fannie said, hey, we're no longer accepting the loan to be submitted this way. We have to see it this way. They may have that information before we do, but eventually it will get down to us. It's not that common, but sometimes will happen. Let's see here on our questions as we go. Okay, this is a good one. How are the underwriter and the lender connected? Is there a one-to-one relationship? Maybe we're talking, broker versus lender. Oh, that was our answer. So yeah, so how are the underwriter and the lender connected? I think that's really important to know who you're doing business with. Here at CrossCountry, our underwriters are employees. So they're all part of our one happy family. If you're working with a mortgage broker, they're working probably with multiple companies, and the underwriters don't work for them. They work for these other companies that they sell their loans to. So I would guess to say the relationship is probably not as consistent. Elaine, I don't know if you want to kind of add anything to that.
No, that's exactly it. We're employees of CrossCountry, and the same as the loan officers and same as the processors. So we're a team, we're a family, and we're working together to fund your loans. Where a mortgage broker or even some other lenders don't have delegated authority where they can just approve the loans on behalf of that other lender, that the loans have to go to another lender.
So Patty asked, does CrossCountry Mortgage offer upfront underwriting with property address to be determined? And that is known as our fast track program.
Yes.
And we are fully underwriting all the pre-approvals that come through. So we are doing that. That is a game changer. I will tell you guys, for your FHA pre-approvals, if they're going up against conventional pre-approvals, they have no chance if the net is the same to the seller. Where they do stand a chance is if we can go back and tell the seller and the listing agent, this has been through underwriting, it's subject to title and appraisal. So that's a big, big game changer. And we definitely do that. We're excited to have that product back. So I'm glad you asked, Patty. Let's see here. Okay. Chow asks, if a loan failed during underwriting, will the buyer get a refund of the loan application fee and the appraisal fee? Well, we don't have a loan application fee, so that's pretty simple, but I know other lenders do, so I can't speak for what other lenders' policies are. As far as the appraisal fee, that was never collected by CrossCountry. That was paid directly to the appraisal management company. And honestly, if they did their work and something came up later that turned that loan down, that money went to the appraisal management company. So that's as much as I could say. We don't make money here across country unless those loans close. So Elaine, I don't know if you wanted to add to that.
No, that's it. It's, we don't collect any money up front for cross country. It's just the third party vendor fees.
Correct. All right. So what would a small leak in a home affect my refinance loan? A great
It
question.
depends on what the appraiser tells us that small leak was. If the appraiser actually tells us about it, then we're going to look at the extent of it and whether he or she made that loan subject to the repairs or as is.
There you go.
So
Yeah,
we're
there you
really
go.
looking at health and safety hazards or structural deficiencies. So
Yeah.
if it's
So if
minor, it may not need anything at all.
Yeah, the appraiser is going to be the one that puts the underwriter on notice that they saw something that's deficient in the property, and then it'll be the underwriter's discretion whether it requires further review. One thing I will tell you is in our market, we have these seller's disclosures. We are not required to have the seller's disclosures in our file. Fannie, Freddie, FHA, nobody wants them. So don't give them to us. We don't want them. It just creates hassle. This buyer knows what's going on with the property. That's all we care about. Don't send us a seller's disclosure. The other thing you should probably never send your lender, and ironically, some of our competitors actually ask for this, is the home inspection. We don't
Don't.
want the home
No,
inspection.
no,
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 do not
no.
send the home inspection here. If you want an underwriter to ask for lots of extra property conditions, then you're going to put it in the file. We do not accept home inspections. Do not send us home inspections. If the lender asks, ask them why, because honestly, there's no reason for those to be in the file. So other than to complicate your files. All right. So we don't this is a question that I wanted to talk about here is, would a natural disaster impact or hurt our closing? Now, in our market, really the only big natural disasters that we get are A, tornadoes, or B, heavy rains and flooding. And then if any of the areas are declared, usually by county, an area is declared a natural disaster area, it could delay the closing, because if the appraiser was out there before the event, we, Fannie Mae, Freddie Mac, FHA, they want to make sure the property's still there. So we have to send that appraiser back out to the tune of $150 reinspection fee, just to make sure whatever that natural disaster event was didn't have an impact negatively on our collateral. So yes, it could in fact delay it, but that's why pretty rare. We're not in California where they get wildfires and all kinds of crazy stuff, and
Earthquakes.
earthquakes, wildfires, and all that stuff. So, although in that chair, you probably don't feel them, Elaine. So it's a pretty comfortable chair looking. So, all right. So I kind of saved this question for last, and we're getting close to the end here too. So if you guys have any other questions, this is important to listen to this one. So Elaine, will an underwriter ever speak to a listing agent?
We don't. See, we
There
have
you
these
go.
fancy chairs we're sitting in, so it's our little our what is it? Anyway, yeah, we don't. We
So
we we talk with your loan officer, we talk with your processors, we talk with the regional managers. We typically do not talk with the realtors, the appraisers, the borrowers. Um,
except for today. You guys got lucky enough today
eh,
to actually speak to an underwriter today. And it's just the way the job is. They make decisions, but they aren't really to be on the customer service side, if you will. So,
right.
but that's a great question as far as that's concerned. Um, let's see, we did have something come in. Oh, can somebody refinance with a credit score in the 500s? I would say FHA, yes. That's about the only way you're going to get that done today. Even the non-QM lenders don't go that low anymore. So
Or
FHA is going to
VA.
be, Yeah, or VA.
We haven't
correct.
talked about VA today at all, but VA also. we can
VA
do.
as well. VA as well. What's the minimum credit score for VA?
VA is no credit score.
There you go.
We can do no credit score loans for VA. The veteran VA program is very veteran conscious. Will they will make accommodations for their veterans to get them into homes.
Yeah, no, that's perfect. There's a question Chow asks is what's the relationship between the underwriter and the closing team? It's a good question.
We are joined at the hip. Because oftentimes, as you know, loans go to closing, we've finished up the file, we've cleared it to close, all the conditions have been met, but something changes at closing when they're drawing docs. They've been back in touch with the title company and they've done a date down. I don't know if you know what a date down is, where from the time that we got that title commitment 60 days ago or 30 days ago, something else has popped up that title is found, then it has to come back to underwriting. Borrowers, suddenly something's changed and we need to change a loan amount. There's all kinds of little things that the closer has to come back to underwriting for a question or to have us update something. But we do those instantly. When a closer reaches out to us, it is stop, drop, and roll. It's not 24 hours, not 48 hours. It is now. We take care of it.
So I don't really have anything else. I guess I got one last question that I can cover in here, and that actually covers our entire list of questions, which we had 22, not to mention what you guys covered here. So great job, by the way. I know a lot of great information went out. We do have this recorded, so we will get that to you. I'll ask this last question and then we'll wrap up. Are there screening questions about a borrower that us agents should be asking? I can't believe I can't read this right now. Let me try this again. Are there screening questions about a borrower that us as agents should be asking to determine how things will go throughout the process? I think the biggest thing about that is, we kind of talked about that now that I think of it. The screening questions you want to ask is how well organized is your borrower? How responsive is your buyer? Those two things are screening questions. If you don't think they're well organized and you know that they're kind of late to the appointments and everything else, that's going to be the same thing that happens in our process. So just be kind of aware and conscious of that. As far as screening them for loan approval, there's just too many different types of loan products out there and things that we can do. I would screen them more for what type of borrower are they going to be for us and how quickly can we get them closed. Honestly, if we can get them into CrossCountry's fast track and we can underwrite them ahead of time, that's going to save everybody a lot of hassle down the road too. All right. With that, Patty thanked us for lunch, and we did provide you guys lunch. I'm glad you guys came to check out this amazing event. We have another topic that we'll be introducing to you guys in the next week or two that we'll be covering next month in our program. I want to say thank you very much to Elaine for taking time out of her day and helping us today and getting you guys education and just paying it forward. I think that's, as long as she and I have been in this business, I think sometimes it's more about paying it forward than anything else. Tony, for sure, this wouldn't happen without her. I know looks like she's frozen, but it's just because she's working so hard. But none of this stuff happens without her. So thank you very much, Tony. Thank you guys for attending, and we will see you next month with another great topic. And perfect. Get a lot of thank yous coming in. So thanks again, Elaine. Thanks, Tony. Thanks everybody for coming in. Take care.
Thanks for the invite.
Bye-bye.